This is the Autumn 2025 Budget Review with Sophie McGilvery.
Hello everyone and welcome to my Autumn 2025 Budget Debrief. Today I will be focusing on some of the changes from what was perhaps one of the most highly anticipated budgets in recent years and what this means for individuals and businesses. Firstly, I want to quickly recap on a couple of changes from previous announcements that are still to occur. The first is inheritance tax and that £1 million allowance. This will need no introduction, I'm sure. From April 2026, estates with agricultural and/or business property will only be able to claim 100% tax relief on the first £1 million of assets. Any value above that £1 million will see the tax relief restricted to 50%. So quite a significant change, and I'm sure most of you are aware of it. The second is business asset disposal relief. So from April 2026, the tax rate on capital gains from disposing of qualifying businesses or business assets will increase to 18%. The current rate is 14%, so that's a 4% increase. Okay, let's now delve into the Autumn 2025 budget announcements. Was it as bad as we all feared? I'll start with individuals. As was widely speculated beforehand, the personal tax allowance will be frozen for another 3 years. This will take us up to 2031. The personal tax allowance is £12,570, and this is the amount of your income that is tax-free. This is being criticised as a stealth tax. So what that means is the government haven't changed anything, they haven't done anything, but by not doing anything, more people are brought into paying tax. So thresholds and allowances stay the same. Gradually, wages and income increase over the years, push more people above that threshold and allowance, therefore paying more tax. The Chancellor also announced the tax rates on property income will increase by 2% from April 2027. If you are in Scotland, this does not apply to you. Scottish income tax rates are determined by the Scottish Government. So for those of us in Scotland, we will have to wait until the 13th of January 2026 for the Scottish budget. Dividend income and savings income are taxed on UK-wide tax rates. Therefore, the announcements from last Wednesday will apply to people in Scotland. So the government have announced the basic rate and the higher rate for dividends tax will increase by 2% from April 2026. So as you can see, the basic rate becomes 10.75% and the higher rate becomes 35.75%. Surprisingly, the additional rate remains unchanged, so that will stay at 39.35%. Is it now better then to take a salary through PAYE rather than a dividend? The margins have got closer over the years as the dividend allowance has reduced to £500. There are a lot of factors to consider, so it will need to be viewed on a case-by-case basis. However, it is certainly something to think about. So the tax rates on savings income will also be increasing by 2%. This will be from April 2027. The savings allowances remain the same, so if you are a basic taxpayer, the savings allowance will be £1,000. If you are a higher rate taxpayer, the savings allowance will be £500. Moving on to inheritance tax. As I briefly mentioned earlier, the £1 million allowance on relief for business property and agricultural property, a welcome change effective from the 6th of April 2026. Any unused allowances will now be transferable to spouses. For example, if a husband had qualifying shares with a value of £500,000, £500,000 of his £1 million allowance will be used. The unused £500,000 allowance can be transferred to his surviving spouse. So in situations like this, effectively there is a £2 million allowance. Home working expenses. So the government will be removing the home working expenses benefit for employees from April 2026. If you are an employee, you have to work from home and your employer does not reimburse you for home working expenses. You can currently claim a flat £6 per week tax deduction, i.e. £312 a year. This will be removed from the 6th of April 2026. Finally, an announcement that affects both individuals and businesses, salary sacrifice. This was something else that was widely speculated beforehand. From April 2029, salary sacrifice pension contributions above £2,000 will be subject to national insurance. So the £2,000 annual cap is a very low amount. Currently, employees and employers both benefit from the national insurance relief. It is a very attractive way for employees to pay pension contributions. Now, 4 years is a very long time, so anything can happen between now and April 2029. So for now, you just want to continue maximising the allowances as best you can. Turning to businesses, overall a sigh of relief maybe. Corporation tax rates remain unchanged. So for taxable profits below £50,000, the corporation tax rate remains 19%. For taxable profits above £250,000, the corporation tax rate remains 25%. You also have that marginal relief for any profits that fall between those two figures. However, from April 2026, the corporation tax late filing penalties will double. So for any lateness, the fee will be £200 as opposed to £100 currently. There were a couple of changes to capital allowances. So from April 2026, the main writing down allowance will reduce to 14%. It is currently 18%. So this will slow down the tax relief and spread it out over a few more years. On the other hand, the government have introduced a new 40% first year allowance for main rate assets that are not covered by the £1 million annual investment allowance, or for limited companies, the full expensing. This is going to be introduced on the 1st of January 2026, and it will mainly benefit unincorporated businesses as they do not qualify for the full expensing. Finally, I will quickly talk about the national living wage changes. So from April 2026, national living wages will increase. For those aged 21 or over, the hourly rate will become £12.71p. For those aged 18 to 20, they will see the biggest increase. The hourly rate will become £10.85p. And for those aged 16 to 18 or apprentices, the hourly rate will become £8. So this will add to the increases we have already had to these wages, plus the employer national insurance changes. This is going to be compounding the costs for businesses. There is still a bit of time before these changes come into effect. So it is best to continue looking at cash flows and forecasts, include these new changes in it from April 2026 so that you can plan ahead. So we have now come to the end of the debrief. Thank you for watching. I trust you found this helpful. I've covered just some of the announcements from the 2025 autumn budget. Should you have any questions or you would like to discuss specific circumstances, please do not hesitate to contact me. My contact details will shortly appear on the screen. Thank you again and take care.